On this episode of the Cleveland Real Estate Investor Podcast, Mike Reilly and Mike Ferrante talk about the Cleveland real estate market's reaction to the Fed's round of interest rates. Surprisingly, there seems to be no overreaction. Instead, a gradual rebalancing to normalcy. Then they talk about ARMs and why you should consider them in your financing plans.
Hi, everybody. This is a quickie emergency podcast, fall heat check with my compadre, Mike Ferrante, coffee cup in hand. Mike, good morning.
Hey, good morning, Mike. Good to be here.
All right. So we're looking outside in Cleveland here, and it's Thursday, and actually my son is getting married this Saturday. So rehearsal dinner is today, Friday. So a lot going on, but we wanted to squeeze a quick podcast in with Mike and do a mid-month fall heat check with interest rates steadily climbing thanks to the Fed. And also the Fed is not buying up any more mortgage bonds. So that's actually kind of a additional pressure on the interest rates. Right, Mike? Am I reading it right?
Yeah, absolutely. Yeah, it's going to be interesting to see what happens here over the winter when things slow down anyway, and with the Fed hitting the brakes even more. You know, I know we got a lot of doomsayers out there saying that things are heading in a bad direction again, but we'll see what the numbers say, right?
Yep. All right. So let's go to our numbers guy. You're our Steve Kornacki of, I don't know if you know who Steve Kornacki is, but he's the legendary, I think he's on CNN. He does all the breakdowns on the vote tallies.
Well, anytime you mention my name and the word legendary in the same sentence, I'm all for that.
All right. Okay. All right. So So tell us what numbers you cooked up here.
Well, so I watch a few things, Mike. I, of course, watch the median sale price, and I also look at number of days to sell a house. That's usually a good indicator of what direction the market is heading, if demand is picking up, if it's staying the same, if it's waning. So I pulled up those two numbers, and the winter lull started a little early this year, and I was watching sale price dip a little bit. It peaked at almost 200,000 for Cuyahoga County for single family homes and condos. I lumped condos into that, and it was dropping steadily over the last couple of months, and then wouldn't you know, it actually perked back up again. So our median sale price in the last month has actually gone up slightly, which these little variations are nothing to get too excited about. But to me, that was a good sign. I think that initial shell shock of all these rate hikes kind of stalled things out. And then, of course, market time. That's the other one I watch. And we hit about 22 days to sell a house, which is still phenomenal. Mike, you remember back in the day, we'd say, look, 30, 40 days to sell a house, that's kind of normal. And no one thought anything weird about that. That's just normal market time. We actually dipped back down to 20 days median market time. So I don't know what it was. I can't exactly put my finger on it. I just ran these numbers this morning.
Well, let me play devil's advocate, or I'm the layman here. Okay,
Sure.
You're the realtor. I'm the layman. Could it be that people are thinking, I need to buy a house now before interest rates get higher?
100%. I think that's a huge part of it. And however, the last couple months, activity was slowing down. So I don't know if it's finally the reality is setting in or what's happening. But I think also that as this higher rate environment continues, and in reality, Mike, what you and I both know, 6s and 7s are not really high rate environments. That's kind of normal rate environments. But as that becomes
compared to the house my wife and I bought 40 years ago, where the interest rates was 16%.
16. Now, I consider that high. I consider 3s and 4s low, but 7, 8, that's normal. 6 to 8 is normal. So
right.
I think that reality is kind of setting in, and the people who were still shopping when it was 3.5%, yeah, maybe they're on the sidelines now. Maybe they'll never adjust, but if they really want to buy a home, they're going to get a 7% mortgage rate and be happy with it.
Now, the reason to buy a home would be that, let's talk about the cost of renting a house.
Sure.
Which I hear on CNBC and Market Watch and all these different financial news out. They're always talking about what it costs to rent versus what it costs to buy. When that spread gets to be a certain point, it makes buying more lucrative. Can you talk about that?
Yeah, so just talking about rents first, a house in an inner ring suburb like a Garfield Heights or Euclid, you used to be able to rent houses for $900 all day long. And when I say used to, I'm not talking about in the 80s. I'm talking about 2, 3 years ago. Now that same house rents for $1,200 all day long. So you look at that kind of increase in the cost to rent, the proportionate increase in the cost to buy is about the same. So people are looking at a $1,200, $1,300 rent payment, and they're not contributing to their overall wealth, which I'm sure we'll talk about in a second, compared to a mortgage payment that might be a little bit higher, say 1,400, 1,500, but you own the home.
Right.
And for that spread, I think people still want to buy.
Right. And then is there a figure that about people's credit scores? Are people taking on more debt? Is that a factor in, heat check for buying a house? That
Well, yeah, that's not data that I have access to, but what I can tell you is that the lending standards have not been relaxed to the extent that they were for the crash of '08.
Right.
You're still looking at FHA. Most lenders are still requiring 640 credit scores, although there are some going down to 600 and 580, but that's really the exception. So, I'm not really seeing the crazy lending practices that we saw back then.
Right. And so when the doomsayers say, oh my God, the bubbles crash popping and we're going to return to '08, '09 depression with housing, the reason for that was lax credit standards. I mean, all you got to do is watch the movie Big Short, where, they were lending money to any drunken sailor coming through the door, right?
Exactly. Yeah.
So that's
Yeah.
what
Yeah.
that's what
Plus,
happens. And then you
it,
had those loans that were structured so that after 1 year their monthly price tripled that they were paying. But the idea was that they would be able to then refinance. Well, all of a sudden, the game of musical chairs, the music stopped, and that's when the crash started, right?
yeah, and that's a great topic. We probably should do a whole additional podcast on the different types of loan products because it's amazing to me how uneducated so many people are in the marketplace. And I'm not just talking about consumers who shouldn't necessarily have a vast knowledge of loan products, but I'm talking about my peers. And I've been going out of my way to bring on experts on my show that I do on Tuesdays, lenders talking about different loan products and the pluses and minuses of them. I'm not going to say any names, Mike, but we were trying to strike a deal on a house and we were so close. And I said to the agent, I said, instead of doing a fixed rate loan at this higher rate that's really restricting your buyer's purchasing power, why don't you have them look at an ARM? And she immediately said, nope, no way, not doing it. That's a recipe for foreclosure. I will only tell my clients to get 30-year fixed loans. And I said, really?
That's the realtor telling their client?
That's the realtor. And so, they're
Wow.
scaring the client into believing that ARMs are evil and that, first of all, look, know the terms of the loan before you sign on the dotted line. So what you talked about earlier, Mike, yes, that happened. There were people who did very short-term ARMs, 3-year ARMs, meaning adjustable rate mortgage. After 3 years, the rate can start adjusting. And people didn't.
After 3 years. After
Right.
3 years, first of all, everybody, and you're absolutely right, Mike. I mean, this is almost realtor malpractice. And people out there, if you're going to hire a realtor, don't hire the friend of a friend. Okay? This is a business decision. We talked about this a year ago in one of our earlier podcasts, but you got to interview a couple of realtors, right, Mike? And one of the questions you want to ask them is their financial literacy in terms of loan products. Because first of all, an ARM in this environment right now, an adjustable rate mortgage, folks, is the way to go. Because first of all, it's going to reset what, in 3 years?
Well, Mike, there's 10-year arms. So now the break you get on the rate is not as big because they're locking you in for 10 years.
But
But
say
if you
it's
could
3 years.
save 3, 5, 7, 10, those are your typical terms.
I would do a 3-year arm all day. And I'll tell you why. Because interest rates are not going up for 3 years. Okay. I mean, once the war in Ukraine is, we're seeing light at the end of the tunnel, the way the Ukrainians are just wiping the floor with the Russians. Once that war is over, you're going to see the oil markets, the energy markets stabilize. And I mean, the market is already starting to sniff a recovery in about 6 months. And that's going to ease the Fed from raising interest rates continually. So a 3-year, I would take that all day.
Yeah, and the break you get on a rate with a 3-year is going to be significant. And when I say significant, I'm not a lender, I can't quote rates, but I'm sure it's 1, 2, 3, percentage points somewhere in that range. And then going back to the caps, Mike, is these people have this misconception that, okay, say I get a great rate by today's standards, 5.5% on an arm. Well, when that term is up, it can go up to 10 or 12 or 15, right? No, it can't. Not typically, because not only is it capped per year, but it's capped for the lifetime of the loan. So in other words, it can't go up more than, say, 2% per year, no more than 5 or 6% over the life of the loan. So, could it go to 10 over the course of 5 years, 3 years? Yeah, possibly. But that's why you got to read the terms and really grill your loan officer as to, hey, tell me about this. Educate me on what my worst case scenario is.
Hey, let's stop here. We got to pay some bills. 30 seconds, and we'll be back. If you've been listening to this podcast, then you understand or should understand the pitfalls of investing in Cleveland real estate. Say you're looking for an investment property to rent, and these are the things that could happen and often do. You overpay for a house, and it's in the ghetto. Then you find that it's a money pit with endless surprise repairs. Your hapless property manager, who may be the brother-in-law of the realtor, gets a tenant who after 3 months stops paying the rent. Then the toilet explodes, and you have nobody to repair it because, guess what? The property manager is not answering the phone. Yep, that's the ugly side of the Cleveland real estate market. But we have a solution. Buy one of our properties. It's been inspected. It's been vetted. It's in a rock-solid part of town. It comes with a Gold Star tenant paying top dollar rent, and we manage it. Call us at 216-371-8160 if you're interested.
Exactly. Yeah. So, again, we've kind of gone from heat check, and are we starting to see deals for people buying a house now?
Well, let me throw some more numbers at you, because
Yeah,
that's a perfect segue into what I was about to tell you next. So look, one of the ways we tell whether or not it's a buyer's or seller's market is how much inventory there is. And in our normal balanced market over the years, I mean, many, many years of measuring these numbers, we're between 4,000 and 6,000 listings on the market. That usually satisfies the demand, causes a even level market. We're still well under 3,000 properties for sale, single family homes and condos, well under the amount of supply that we need to meet that demand. So that said, while inventory is rising steadily, here's a number that a lot of people want to know about. So back in the day, Mike, when we'd talk about writing an offer for anyone, our general rule of thumb was, hey, as long as we're 90% of list price, that's a respectable offer. Under 90%, there must be something wrong with the property, or maybe it's been on the market for a real long time. So we would measure the list price to sale price ratio. And for a while, things were selling over list price. Not like some markets where they're going 30, 40, 50% over list price. But just this year, May and June of this year, we were selling houses at 103% of list price. 3% over. That's the median. Okay. So Now fast forward, each month you're seeing this graph plummet. And by plummet, I mean now we're at 98.5% of list price.
Wow, that's still great compared to historic Cleveland trends, right?
Right. Your typical percentage of list price to sale price ratio is about 95, 96. That was the median number over quote normal years. So I know I keep saying we're getting closer to normal balanced market. I'm throwing all these terms out. That's because the numbers show it. We're going to get right back to that 95, 96% of list price to sale price ratio, like it, I don't want to say should be, but like it has been in a balanced market.
Right. And then you gotta, I know you're just throwing these numbers at warp speed. So listeners, feel free to rewind a little and replay what Mike just said, because even with the coffee in me, I'm still, okay, now what did you just say, Mike? Okay. So we got that number, that list price ratio, which at 103, 103% was a buying frenzy, right?
Correct. Yep.
Okay. This is where you throw a house in the market and people would make offers and they wouldn't get it. So if they weren't getting that house, then the next house they looked at, they would ask more. So it started becoming the norm. If it was listed for 200, you would make an offer for 205. And somebody came in at 210, then your next house, we got to find a house. You're going even higher. And then as people, word of mouth, as people start, getting these offers accepted, then it starts dropping. Then, the market is not conditioned to always be asking more. Now, people are conditioned like that in LA, right? I mean,
sure.
You put a house down for 200, they come in at 250, and for that garage they want to buy. That's how crazy the prices are there. So, but so we got that one lane, okay? That one lane about that. The other lane is time on market, right?
Right. And now we're at about 20 days. So
that's still a seller's market, right?
It is. Yeah. At the very bottom, meaning when homes were selling at lightning speed, our median time on market got down to about 6 days by comparison. Wow. Yeah. Wow. Incredible.
Yeah, that was, again, and if it was at 6 days, then of course your percentage of over list would be over 100%, right? So
that's right.
All these
numbers, right? All these numbers tie together, Mike. So as we saw inventory, number of listings drop, that skewed this whole demand versus supply thing. Days on market dropped, prices went up, and they all correspond either inversely or they follow each other, or they follow each other inversely.
Right. Now, so we're planning on putting 2 of our rental properties on the market, and right now we have tenants in place, and we're going to put it out there at a certain price, a little bit more aggressive in terms of pricing. I'm thinking about our Blackmore house. And now, why am I selling this? We're going to be raising cash. We're going to be reinvesting in another unusual house. Right now, we're kind of liquidating some of our properties that we bought in 09, 08 during the crash. Now we've got a lot of 4 bedrooms, a lot of great houses. It's time to diversify our portfolio of property. So we're going to be selling it at owner occupied. And those are probably going to be listed in about, 3 weeks or so. Should we present these houses to realtors with financial? I mean, what happens if you get somebody coming in who's got an incompetent realtor who's telling them don't do arms or don't do this or don't do that? I mean, what do you do? They like the house, they want to buy the house, but they got some knucklehead realtor who's counseling them not to do an arm.
It's a tough spot because, of course, as the seller, as the listing agent, we don't have the ear of the buyer unless we're representing the buyer. Most of the time they're represented by another agent. So, we can try to get through to the agent so that they can relay the information. And, my earlier story, I was unsuccessful. That agent just didn't want to hear it. Sometimes agents will be receptive, depending on how you deliver that information. So if I come across, hey, what are you, stupid? You should be doing this. Obviously that's not the way to do it. But if I present it in a way, hey, how much do you know about different types of loan products? Have you considered ARMs? Have you educated yourself on ARMs? How about buy downs? So, we didn't, and again, Mike, we could do a whole podcast on this, but
we're going to do our next podcast, Mike, after this wedding. Our next podcast is going to be on ARMs and financing. But let me just interrupt you real quick.
Yeah.
Can we market this house with financing available?
Sure. There's a couple of ways to do that. You could owner finance if you really wanted to. The other thing that we're doing to kind of open people's eyes is that we're actually posting seller can pay, how are we phrasing it? With a $4,000 seller credit, I'll just give you a concrete example. We have a $300-some-thousand house. We asked our lender, hey, if we did a $4,000 credit, what kind of rate could that buy a buyer today? So in other words, the seller gives a credit, seller pays some money up front, and gives the buyer a credit so they can buy down their interest rate. It's like prepaid interest. So we're advertising a house right now with a $4,000 seller credit and a 5.5% interest rate.
Okay, there you go.
And that's not a bait and switch.
That's how they sell. That's how they sell cars.
That's right. Absolutely.
Yeah. I mean, they're not only buying a car, but they're, I heard a long time ago, Consumer Reports, they said that most people will look at a car and their first question is, how much is it per month?
Mm-hmm.
And they may be overpaying with that car because, used to be you go in, you'd figure out what a car cost, the dealer. And then, when I buy a car, it's always like cost plus. All right, how much the car costs $30,000. I know it costs $30,000. Mr. Car salesman, it costs $30,000. How much do you guys want to make in profit? And then they say 1,000, fine, 31,000. There we go. Now let's talk about financing. Most people don't have that conversation. Most people, what they will do is they will say, the dealer will say, I can get you this car costs $33,000 and your monthly is going to be this X. You're actually paying $2,000 more than you should. But your focus is on the shiny bubble, which is the monthly payment, right?
Exactly. There, and there's all kinds of little nuances to that. The dealership makes money on financing. The dealership makes money on the manufacturer little kickbacks or whatever they call them. Because they just because that car costs $30,000, Mike. Sometimes they're getting incentives from the supplier saying, oh, you bought 150 cars last month. Here, we're going to give you 10 grand back. So they distribute, so there's sometimes they're making more than they actually show you, even with that transparency that you think you have.
Right. Well, so when we put our houses on the market, and folks, you can follow us along as these podcasts go, because we're going to do a whole podcast on ARM and financing. We're not only going to be putting a prospectus on the house, pictures on the website, people can look at, maybe even a video, a walkthrough, stuff like that. But then we're going to put together a financing package, because I have a feeling these houses, the Kingston house, Mike, the Blackmore house that we have for sale, these are perfect starter homes. These are not retirement homes. This is not, some luxury mansion, right? These
Right.
are the classic starter homes. So that financing is going to be important. Even a credit on repairs down the road if they need it. Like we have our whole maintenance team on our contracting side. We can give them, we can put together a package which is compelling to the first-time home buyer, right?
That's right. It's about more than just the price, especially now in this changing market.
Yeah, exactly. So, we're seeing how the tides are shifting, how the waves are coming in to the beach now with the Fed raising interest rates. This is where home sellers, as well as home buyers, as we go out to the market to look for properties, we're looking for certain criterion. Has it been on the market for a long time? Now somebody fixed it up, like our Fairmont house. Investor company fixed it up. They're seeing interest rates go up. They're dropping the price. And this is where we come in with cash and swoop it up, fast close, because this is what they want. You're always trying to understand what the market wants. What does the buyer want? They like the house, but they're having financing. They're confused about financing. If we are offering financing package, we can bypass that incompetent realtor, right?
That's right. Yeah, it makes total sense.
Yeah. So yeah, because the buyer is going to ask the realtor, so what about this? And they're going to ask us.
That's
and
right.
we can do an end run around that. So
yeah, it's all about adapting to the market, Mike. We were finding that was a hurdle, and so we said, hey, how can we educate people? How can we at least get them to ask the question? And that's what we came up with, and that came from my coach. Always have a business coach, guys.
Yeah, exactly. Really. And go on YouTube, go on a TED Talk. A lot to learn in YouTube University out there about this stuff. So we are now getting into the fall, into the winter, where we're going to be buyers and sellers, and we're going to tweak the model, and we will keep everybody posted as we go forward. So, Mike, I know you got to get on another Zoom. You're a very popular guy, so tell everybody what your Tuesday videos are, or is that on Facebook? I mean, what is it?
Yeah. So we put it in a few different places. We do a free Tuesday training, 11:30 Eastern time. They go about 20 minutes. Sometimes we have guests. We have people talking about financing. We have well, Mike, you were a guest. We talked about contractors and how difficult it can be to vet contractors and that whole process. But it's available on Facebook Live. So if you just look up 21 Mike Team to follow us on Facebook, you can watch it there live. And of course, the recording lives there forever. You can join our Zoom meeting if you want, but the easier way to do it is on Facebook, or go to our YouTube channel, Mike Ferrante, Cleveland Realtor. That's how you'll find us. And we post those videos after the fact, the next day. And then we also take the audio and put them on our podcast, which is Free Beer and Real Estate. I don't know if you've heard that one, Mike.
I don't know. Free beer and real estate. Well, that'll get some searches.
It's one of those things, like if you ever been to a bar, Mike, and they say there's a sign that says free beer, and then at the very small print on the bottom it says tomorrow. That's our thing. Yeah, the free beer is always tomorrow.
Speaking of bait and switch, we're going to end on that note, folks. Okay. All right, Mike, go to work.
All right. Have a great one.
All right. We'll talk to everybody next week. Okay.
Thank you for listening to the Cleveland Real Estate Investor Podcast with Mike Reilly. Please add our show or follow us on Spotify, Overcast, Apple Podcast, or Spotify. Leave a like or comment on the video. All engagement is appreciated. Subscribe to us on YouTube as well for video content coming soon. For any Cleveland listeners or Cleveland Browns fans, you can check out our other podcast, Cleveland Browns Anonymous, for our weekly group therapy session. This is also on all the same platforms as the Cleveland Real Estate Investor.